We live in a world where investing is often portrayed as a path to quick riches and effortless success. The glossy magazine covers, the social media influencers, and even some financial advisors all tell us that with just the right tip, the right stock, or the right cryptocurrency, we can make our dreams come true. But behind this alluring facade lies a darker, more sobering reality. Investing, far from being a guaranteed route to wealth, is fraught with risk, uncertainty, and the potential for significant loss. Today, we're going to peel back the layers of this enticing narrative and confront the harsh truths that many would prefer to ignore. Investing has long been seen as a cornerstone of building wealth. We hear stories of people striking gold with the latest stock, real estate deal, or cryptocurrency, turning modest sums into small fortunes. But while these success stories are celebrated and shared widely, the untold stories of financial ruin and heartbreak are often left in the shadows. Let me begin with a true story that underscores the dangers lurking in the world of investing. In the late 1990s, the tech boom was in full swing. Everyone was buzzing about the next big thing in technology. Companies with little more than a catchy name and a .com domain were attracting millions of dollars from eager investors. One of these companies was Pets.com, a now infamous example of the .com bubble. Backed by substantial investments and a high-profile marketing campaign, the company went public in 2000, with its stock initially valued at $11 per share. But within just 9 months, the company collapsed, its stock plunging to a mere 19 cents per share before being delisted. Investors who believed in the hype and poured their savings into Pets.com lost everything. This wasn't an isolated incident. Many companies of that era faced similar fates, resulting in the loss of billions of dollars for investors. This brings us to a crucial point. The market doesn't always reward optimism or innovation. Sometimes it punishes it. The .com bubble is just one example, but it's not an isolated case. Consider the 2008 financial crisis, another stark reminder of the dark side of investing. Leading up to the crisis, the housing market was booming, fueled by risky lending practices and the proliferation of complex financial instruments like mortgage-backed securities. Wall Street was making billions, and many investors believed that real estate was a sure bet. After all, housing prices had been rising for years, and the narrative was that they would only continue to go up. But when the bubble burst, it led to a global financial meltdown. Trillions of dollars in wealth were wiped out almost overnight. Ordinary people lost their homes, their savings, and their sense of security. Many investors who had trusted in the safety of real estate and the banking system found themselves financially devastated. Even today, the allure of easy money through investing is as strong as ever. Take, for example, the rise of cryptocurrencies. In 2021, Bitcoin reached an all-time high of nearly $65,000 per coin, sparking a frenzy of investment. Stories of early adopters becoming overnight millionaires dominated the headlines. But just a few months later, the price plummeted by nearly 50%, leaving many latecomers with massive losses. People who invested their life savings, hoping to ride the wave to financial freedom, instead found themselves in deep financial trouble. The truth is, investing is not a game. It's a serious, often risky endeavor that requires not just knowledge, but also discipline, patience, and a clear understanding of the potential consequences. For every story of success, there are countless stories of failure, stories of people who lost everything because they chased the promise of quick returns without fully understanding the risks. So why is this dark side of investing so often overlooked? Part of it is psychological. As humans, we're wired to be optimistic. We want to believe that we can beat the odds, that we can be the exception to the rule. Moreover, the financial industry, which profits from our investments, has a vested interest in promoting the upside while downplaying the risks. After all, stories of success sell far better than tales of caution. But as investors and as people who are responsible for our own financial futures, we need to look beyond the hype. We need to educate ourselves about the realities of the markets we're entering, and we need to be prepared for the possibility that things might not go as planned. Investing can indeed be a powerful tool for building wealth, but it's not a guaranteed path to riches. It's a journey fraught with potential pitfalls, And if we don't navigate it carefully, we could end up losing far more than we ever hoped to gain. As we've seen, the history of investing is littered with examples of market euphoria leading to devastating crashes. But beyond these well-known cases, there are subtler, everyday risks that can quietly erode an investor's wealth over time. One of these risks is the danger of following the crowd, often referred to as herd mentality. When everyone is talking about the latest hot stock or investment trend, it can be incredibly tempting to jump in, fearing that you might miss out on big gains. But this type of thinking can lead to disastrous outcomes. Take the case of the housing bubble once more. By 2006, it seemed like everyone was buying real estate, and home prices kept climbing. Even those who had no experience in real estate were taking out massive loans to buy properties, assuming they could only gain value. But when the bubble burst, these same properties became worth far less than the mortgages taken out to buy them, leading to widespread foreclosures and financial ruin for millions of Americans. Herd mentality is not just about bubbles and crashes, though. It can also be seen in the steady, slow losses that occur when people invest in popular but overvalued stocks. When a company is trendy, its stock price can get driven up by enthusiastic investors beyond what the company's actual performance justifies. Eventually, the market corrects itself, and those who bought in at inflated prices find themselves holding stocks that are now worth far less. This happens not in spectacular crashes, but in quiet corrections, where the losses might be smaller but just as damaging over time. Another significant risk in investing is overconfidence. Many investors, especially those who have seen some early success, begin to believe they have a special knack for picking winners. They start to take bigger risks, often without a full understanding of the potential downsides. Consider the story of Long-Term Capital Management, LTCM, a hedge fund that was founded by some of the smartest minds in finance, including Nobel Prize-winning economists. In the 1990s, LTCM was incredibly successful, delivering huge returns to its investors. But this success bred overconfidence. The fund's managers began to leverage their positions massively, borrowing huge sums of money to amplify their bets. They believed their models were foolproof. However, when the Russian financial crisis hit in 1998, their models failed, and the fund lost nearly $4.6 billion in a matter of months, threatening to collapse the global financial system. The Federal Reserve had to step in with a bailout to prevent further fallout. LTCM's downfall is a powerful reminder that no one, no matter how experienced or knowledgeable, is immune to risk. There's also the issue of hidden fees and the cost of investing. Many people don't realize that even seemingly small fees can have a massive impact on their returns over time. Mutual funds, for example, often come with management fees and other expenses that might seem minor, perhaps 1% or 2% annually. But over the course of decades, these fees can eat away at a substantial portion of your investment gains. According to a study by the Department of Labor, over a 35-year period, a 1% fee could reduce your retirement account balance by nearly 28%. Investors who don't pay attention to these details might find that their nest egg is much smaller than they anticipated. Additionally, there's the very human tendency to react emotionally to market movements. When the market is booming, it's easy to feel euphoric and throw caution to the wind. Conversely, when the market crashes, panic can set in, leading to rash decisions like selling at the bottom. These emotional reactions are often counterproductive. For example, after the market crash of 2008, many investors sold off their stocks in a panic, locking in their losses. Had they held on, they would have eventually recovered and even profited as the market rebounded in the years that followed. Studies have shown that investors who attempt to time the market, selling when prices drop and buying when they rise, often underperform those who simply stay invested for the long term. So what can we do to protect ourselves from these risks? The first step is education. Understanding the principles of investing, including the risks involved, is crucial. It's important to diversify your investments, spreading your money across different asset classes like stocks, bonds, and real estate, so that a downturn in one area doesn't wipe out your entire portfolio. Another key is to maintain a long-term perspective and avoid the temptation to chase short-term gains or follow the crowd. Finally, being aware of the costs and fees associated with your investments can help ensure that more of your money is working for you, not for someone else. Investing is not about gambling or chasing the next big trend. It's about making informed decisions, understanding the risks, and managing them effectively. By approaching it with caution, discipline, and a solid strategy, we can avoid the pitfalls that have trapped so many others and build a more secure financial future. If you enjoyed the video, please subscribe so you don't miss out on any important information when it comes to wealth and finances.